Good evening. This is the Eye of the Storm podcast for the S&P 500, the NASDAQ 100, the cash market, the 30-year bond yield, the 10-year note yield, gold, silver, and the dollar index. And today's date is Saturday, January the 7th, 2023. It was an extremely interesting day on Friday in the bonds and in the equities, and for that matter, in gold as well. So I'm going to begin today's podcast by continuing the conversation on inflation. So last week I spoke about inflation. I spoke about how it's kind of getting a bit of smoke and mirror scenario going on there, and what's real and what isn't, and how do we want to factor things in, and how do we digest the opinions or the news that we get on the markets, the condition, where we should be looking for the next month or the next week or the next 6 months. I think that's all valid, but I think there are varying degrees of intensity of what the market's capabilities are. And so we're constantly being barraged or with the thought process of not really being in a realistic manner in terms of this is what's really going on underneath all of that, that the markets are not really heading in the right direction, that we're going to continue to correct, et cetera, and the reasons why. So I think that when we twist things around and we're due for a corrective move, that the only way that we can spin it and get the word out is to go right back over to the heart of everyone basically has been put into positions. Now let's consider this, please. When people are trading now, millennials, Gen Zs, in 10, 15 years ago, people would go and they would buy individual stocks. People own shares of Apple. They had that ownership. They had the shares. And that doesn't really exist more today, because just investing in one stock left you out of tremendous profits that were being seen across the board in sectors. So hence came the design called ETFs, electronically traded funds. And they are everywhere in all the sectors. Sectors can be grouped together, and then you can get an ultra long and an ultra short ETF on those sectors, on particular indexes. So this whole market, the ETF market, electronically traded funds, has exploded. Now there are many players, but three top names that will constantly stick out as ETF managers, owners, managers, and that's BlackRock, State Street, and Vanguard. They sit up there at the top of that old pecking order, and they control a great deal. Now, mind you that I also believe that we need to kind of take a look at like a lot of this money is kind of going and how things are ending up. So when we take a look at an ETF market, we're trying to determine is what is really going on. So what is happening is what you can basically call it's asset manager capitalization. So we have asset managers now, firms that what they're doing is managing the assets of higher wealth people. And a lot of these larger asset managers have to do with all of the ETFs, because that they go in and that's where they put their money and they trade and they own those ETFs. Now, so that switch has been pretty big. So again, in today, the three biggest asset managers are BlackRock, Vanguard, and State Street. global advisors, excuse me. And together, collectively, right now, they manage over $22 trillion in assets. So when we're talking about the money that's been pushed into our system, start taking a look right there. Where's it sitting? And that's just basically in their funds, which cover many, many, many asset classes. So $22 trillion in assets. And the pile of assets, it's actually gotten bigger. It's grown by 4 times since 2008, 2009. So that's how much money has now been pumped into the system, $22 million. And there it sits, 22 trillion, excuse me. And so you can see where a lot of it's been accumulated over the years. So now, but what does this say? So if you really kind of read some of the news, I think it was Bloomberg that said that the big three, these large companies that control these ETFs, and there are others, right? So it's not just the big three, but there are other large firms that control ETFs and mutual funds. But on average, they own 21% of all of the S&P 500. So when you really think about it, they're major shareholders and about 96% of the companies within the S&P. So it's real. It's real. And so when I try to put that all in to understand how things are trading, there's a lot of control that's in a much smaller group, but larger in terms of volume and capital, smaller in terms of how many hands are making that decision. Because the masses have given them their money to manage. So they're asset managers, and they're the ones that are in control. And what they want, they get. Now, because they can move the capital around. So what we really have been seeing is a lot of accumulation distribution amongst these big funds, asset managers, portfolio managers, et cetera. As we moved into year end, we're now into the new 2023. What do you want to do? Where do you want to position yourselves for what they think is coming? It's a difficult task, I have to tell you, but a lot of it is going to be, of course, being done quantitatively. And therefore, artificial intelligence algorithms are at work. Now, where I want to begin tonight is we're trying to put all of that in to the reality of what's actually happening to the economy, because that's causing adjustments. We've seen a major adjustments within the tech sector on an equity basis. So does not suggest, but there's just been a rotation out of a lot of companies and into other companies or asset classes. So that's going to continue. And what that really does, folks, is it presents us with a multitude of trading opportunities across several asset classes. So we just have to really think. And this is all going to be important, because don't forget this, like I've broken it down to where within our equity markets, it appears that there's about $6.1 trillion just searching for homes for the next 3 months, 3 weeks, 10 weeks, whatever the option expiration cycle fits, then that's really what's going to be controlling where the money is flowing. So it'll go from one into another, into another, into another. And it just rolls constantly as the market moves through its troughs. You know, where it's going, it's ebbs and flows, ebbs and flows. It's peaks and troughs is what I meant to say before. So again, this is where Elliott wave comes in. And when accompanied by Fibonacci, we can start to put some parameters around what's going on without having to take a side, without having to pass an opinion, without having to say anything other than this is what the wave pattern is telling me, and here are the probabilities of what that wave pattern can do. And when you can see it in front of you, it may add a different dimension to how you want to just view the whole thing and trade it, because there are many different styles of trading. Like right now, I'm going to begin to look at a yield chart, but that yield chart, to begin with, it's a maximum monthly that I can get thus far, but it goes back to 19, oh wow, what does it go back to? 1922? Can't. Let's pick it up into real time. 79. 78. So back in the late 70s. And this would be the 30-year bond yield. And so we can monitor it all the way up to the top. And that would have been at the end of 1981. And right now we figure that that top is about 1507. That's percent. That's the yield, 15.707% at the end of 1981. Then we can count. So here is a bear chart. What can we figure that we can try to count? 1, 2, 3, 4, 5. You can. You can. Sloppy as all hell. Sloppy here, but very definitive right there at the end. Very definitive from the time that they injected the balance of the capital to get this yield to scream to its low. Now, we don't need to go into why you would buy that low. Why you would then go and give somebody your dollars to buy that low. That's a whole different conversation. We're just going on the yield and the Elliott. Now, if this indeed 1, 2, 3, 4, 5, ABC. 1. See, it's all very choppy, but it does count. That would be 3. I would say that could be a 4, but just very weak. And then we just kind of tumble. And it fits and starts and fits and starts, and then finally tumble in this 5th. So this is kind of very bizarre. Nonetheless, we are in a corrective pattern. Now this is the line chart, so that's the close. Sometimes when you do switch it and go back to the candle, you'll definitively see the 5s. And we got a big sliding 5 down to here, goes up, and then we start down again. So we can get 1, 2, 3, 4, 5, 1, 2, and then we start to break. Larger low, spring back up. And this is again 2008, 2009. So we can get to where rates dipped. Why? Because they injected stimulus. They injected large amounts of money to save corporations. Bing, 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 bing. Low, back up now. Now you've given them all that money and they're going to charge more for us to have it. So bing, and then we recover. Then we start to drop again. And we can track out all the different movements. And here again, COVID. This is November of 2018. We know what that story was all about. Bam, bam. Lots and lots and lots and lots of stimulus. And when that stimulus money all was made available, what happened to the interest rates? Bing, bing, bing. This was COVID, drove COVID. Inject, 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 inject. You got all this money. Bam. Now, what is this all about? That finished the lowest rates can get. Now you've overinflated your money supply. So what happens? Well, those interest rates can't hold because the line at the window to get them is far too big. So the government has given out a lot of money at those rates. And now they can't attract dollars unless they start raising these rates, which of course they're desperate for the dollars, et cetera, et cetera. There's a whole bunch. We have additional needs. Create stimulus, put that money, $1.7 trillion into the system. Ba-ba-bing. Those all inflation is real. And that's what happens to the yield. So the bond yields, when there's money to burn, plenty of dollars, the bond yields will sink. You'll hit the lows. What's going to make bond yields rise? Well, inflation, the cost of goods, the flow of money, who has it and who doesn't. So, if people suddenly they're going to need, there's wage inflation because we need more money. If people are unemployed, the government's got to pay more money. There's all the money supply will be important. So again, back on the Elliott basis, what we have going on here is that we have a correction. Now, if I can count 5 down, which I believe I just did, then I think we go over and we're going to look at retracements from that high, from 1981 high to the low. We're looking for what are yields capable of doing on a Fibonacci basis. So we're looking at retracement levels. How high can yields go on a Fibonacci basis from high to low this far in this corrective move? I still believe that the trend is down. If we just finish 5 down, well, we're going to do 3 up, and then we're going to do another 5 down. So what does that mean for yields? Just that straight Elliott speak there. What did that mean for yields? The trend is down. Yields will go lower. We're in an ABC 3-wave counter trend rally in bond yields. So we expect that the yield is going to go higher. We see that the yield is going to higher, but suddenly everybody goes, well, that's got to be enough. Well, okay, that's where I start to turn back to Fibonacci and go like, well, is it? Even if I'm counting 1, 2, 3, 4, and this is the 5th, and it's only wave A of this ABC that's going to go up, then anything, I'm in a B wave, and I may still be in that B wave. Either this is just kind of going to turn into a 5 waves up, still going to be an A wave. So, but we might get that yield might be like, oh, okay, so this internal count might only be 1, 2, 1, 2, 3, 4, 5, 3, 4, one more 5. Oh, okay, so what happens then? Then that's the A wave. And then we do the C wave, where the yields head in the other direction, that they go counter trend to the trend that they're in. So, right, A, then we get a B. Well, we can get a bigger drop. And that bigger drop could take us actually, folks, out until mid-2023, where we start to come back and the yields drop again down here in the 30-year, maybe down to 3.5, 3.5, maybe even as low as 3 1/3 or 3 1/4. So, but I would not be looking for it to drop down to 3. But could it? Sure, it could. It could. But then turn again now, because remember, same thing as we were talking about in the bond price itself. If we just did 5 down we just did 5 up in price, we're doing an ABC down. And I'm going to go real quick because I didn't want to spend a lot of time. So we've done 5 up, and now we're working on that 3 waves down, but this is turning into very quickly into a first thing down will be a 5 possibly. Or it's the A wave, and now we're in the B wave, and then we're going to do a C wave down. So be a larger ABC against that. That's truly the count in bond prices. So the bond price has yet to drop again. That in and of itself, brings about the situation where the bond yields will rise. We're looking for the bond prices to fall, the bond yields to rise. Now, within the same concept that we went from the bond yield high to the bond yield low, and now we're looking for that counter trend rally because the longer term trend is still down. But we got to put this in before we can resume. Okay, so what do we got? Over the very near term, and again, I want to go back over, to my here, and I want to put up the line chart, makes it very clean. And I'm going to drop down and I'm going to go to the 3-week chart. Nope, I'm going to go to the 20. 20. This is much cleaner. Then I can open this one up. And we can start to see this structure going up. It's very nice. This could almost be a 1, 2, and that could be a 3, and that could be a 4. And this would be a 5. And this very steep, this very steep climb reaching up. And that would have taken us into the end of November. Now, we can see that we've done a turn, and now we're heading back up. In fact, we closed the week right around 395-ish, I guess. That's where I'm going to go on this, 397. Even with the strong rally that we saw in the bonds on Friday and actually most of last week. So, but we have to now consider that we have within this, if I'm looking for a little bit back, a little bit larger of a pullback, A, B, and we have a C wave down in yields, C wave up in bond price. Going to be interesting. So the 30-year has, on bond price, it has some room. It can get itself up there. It can go further. In fact, we could still be in terms of the bond prices. I've discussed and said that we could still have this ABC up. And if this is the case, then this is going to be wave A, and we're still in the B wave down with a C wave still yet to come. Higher here in bond yields, lower in bond price. So I'm going to not try to keep it confusing. We're going on to yield. So the yield, I think we stand a chance of dropping back towards the 50 on the weekly chart. The 50-period EMA is at 318, 316, 319. Sorry. So, we're talking like 3 1/4. So we've gotten as low as 3 1/2. So now we can drop to 3 1/4 before the bonds turn again and start heading. The yields start heading up. Now, where else can we go when we're talking in that respect? Sorry, I pushed that thing, got that thing all going. There you go. I've got to pull it back out. Let's go back out to that maximum and then back down to this 20-year. So we have 0.382 at 0.649. And I am going to go back out to that monthly chart. 6.6, almost 6.5. So first we have 4.5. That's up next. That's the next resistance level. 4.5, and then a break there. You can see it kind of gets a little empty. We've got stops we can make along the way. 5.93, 5.5, 5.5. There's probably 5 1/4. So we're going to start, once we break 4.5, then we're going to be looking for 4 3/4, 5, 5 1/4, 5.5, etc. These are more in tune with what the fibs against the yields will tell us. And you can get those levels in the futures markets due to price. Now, so we have that 4.5, 6.5, 8 1/4, 9 3/4. That would be 618. Can a B wave go that high? It can. It can. And that's going to coincide. That should coincide with that far out should coincide with what I would think a destructive cycle C wave in the equity markets would do. Or another earth type shattering thing. Something severe has to happen. Equity markets, if interest rates go to 9.7%, equity markets are going to be nowhere near where they are now. All right, I got to go down to the 10-year. We're going to be talking about this stuff way too long. And so we just need to go to the 10-year because it's pretty much telling us the same story. And so here again, nice chart. So the high in the yield was back in 1981, at the end of 1981, at about 15.68-ish. I'm going to say 15, yeah, 68. Then we did a beautiful, nice little messy, but all in line. 1, 1, 2, and then a grounding 3, a 4, and then a very definitive 5 to those yield lows. A 0.55 on my chart, but then we're going to leave it there. So 0.5% on the 10-year note. Now, so same deal. If I can come 5 down, we're in a counter trend, right? The longer term trend for interest rates remains down because of even if I take it back and I'm looking at from that high to the low, I only can count 5. 5 all by itself is never a complete move. So I'm on a monthly chart. So this is over a very long term. We will go pretty much round turn. We'll go up, but I don't think we go back as high as 1981. But I think we can get up to 6 to 8 to 9 or close to 10%. And a 10-year note, sure. That you can kind of look. But again, that's extended out. That's going to take time. That's not going to happen next week, next year, or the year after. Probably, excuse me, it could be the year after. It could be like into the fall, into the winter of 2024, into 2025. Yes. But that's going to be a turning point. That's going to be a spot where it's like, oh, okay. We're ready to start moving into the next phase of a stronger economy. But I think all of this has got to happen first. So 10-year note, same deal. We could be involved right now in an ABC. But let me go down to even one smaller. A, B, and then we put a C wave in. Then now the 10-year note, look at where that 618 is sitting. As of Friday, it's sitting right at 3%. So we continue to have on a weekly basis and all else on that monthly basis, the moving averages are in alignment for the rates to continue to go up. That has not been broken. So prices came down. They've skidded off of the 2021 period EMA on the 10-year note, which was at 3.5. And that's right where it went, dipped slightly below and came right off of, as it should have. Because the trend right now, it's counter trend, but the trend right now is continuing for rates to go higher. But again, if I'm considering this wave A, I've got a B wave. What are the limitations of that B wave? Here we have retracements. So I'm going to come back down to this level, and I'm now going to run it up to this level. So we have 3.25 support, but actuality, we got 3. So we now have an ABC down where the A wave got to 3.5, and the C wave is likely going to get us to 3%. And then from the 3%, we'll take off again. So really, what's the trade now? Possibly sell current by 3. So, you're yeah. Or in essence, you're going to buy 3.75, converting that to price in the 10-year note, and you're going to sell 3% in the 10-year note. The price, the bond price. So, but in the yield, I'm selling 3.75, and I'm looking to buy 3. And I'm believing that 3 should come over a little bit of time here as we work our way to complete this primary C wave. That still is out there. There's a couple of accounts over in the equity markets that are not going to jive with what could possibly start happening here in the interest rate markets. So, but the yield is the yield and the market is the market, and that's what it's suggesting right now. Now, going down my pecking order, right? We just did interest rates. What would be up next is currency. The dollar in the index continues to bewilder me a little bit, because I continue to look at this as a C wave, and I continue to look at it as a 1, 2, 3, which leave this as a 4. But this is very impulsive, actually, on a closing line chart. Got a little bit of a rally, picking up off of lows we saw at the end of December. But nothing to really write home about. We're being held by a flat 50 period. And here again, it remains, although these have turned pretty seriously, we've got the 5 period getting ready to go give a knock on the 50's door. That to me is not good. And then right behind it sits the 8 and the 21. And is now very flat, which does not suggest breaking, suggests that it might do one of these. And that would fit to a lot of other things that are going on. But right now, we did put in a little bit of a good rally pretty initially after the employment situation numbers on Friday. We got a decent little rally going, that all of a sudden it stopped, and it was like, okay, what's next? So I'm not really sure. I continued to look at 104 as being support, but now it's kind of turned into resistance. It's low level resistance and should not be that difficult. If we can get this thing going, break back above this 5 and up towards that 8, I would be hoping that we get something done. Because there's a lot of things that kind of go in and out of the dollar. And so I would like to see it across the board, because coming into here could also start to propel the bond market to do its thing. So a lot going on. Continuing to find support, but here's our next level. That's the last thing I wanted to say as well. Our next level is 102.072. So 102 down here in the bottom. Below that, then we're dropping, and then we're going to go below 100. We're going to go below par. And that's going to take us down to below 100, down at 99. So I definitely don't necessarily want to see it down there, because I don't think yields are really going to be equivalent. So that's why I think this, if we get an uptick in yields, then we should see an uptick in the dollar. Now, over into gold. Gold kind of caught a little bit of an edge, and it's good to see. Again, I'm using the line charts and all these because of my longer term chart that I'm looking at. I can go out and I can go to my monthly max on this, and it still fits very cleanly within the count. But it looks like we got a possibility that it's going to be getting ready to go. On my monthly maximum, I don't even see any of the little corrections in there. It's been a pretty steady rally phase. Here we begin to see where it's gone. But here I can kind of come in 1, 2, 3, 4, 1, 2, 3, 4, 5, and maybe I got a 1 up there. Because don't forget, I'm looking for a larger 5. So I'm not, on a weekly chart, where do I get it? If I'm even looking for a minor 5 up to complete, I think it's going to be a third. We're looking for the completion of an intermediate third wave, and I'm definitely looking for this to break to new highs to complete that pattern before we get an intermediate 4, and then we drop into the intermediate 5th wave up, and that's where I think we're going to get the fireworks in gold. So I think that the big ass trade to new highs that aren't going to stop is yet to even begin. So dropping this back down to the weekly, let me go one more. We have the possibility that, yep, gold can rally up, put in a little bit, and then start to rally strongly to get, first of all, intermediate wave 3 done. So I really think we start to break. And well, look, Friday was not a bad day for the effort. But normally what happens after this is that we start to see it drop again. Now, correlation between the dollar, euro, and all of this, I don't know. There's validity to it because they do react to it. But as to its longer term implications, yet to be seen. So right now, I do continue to hold a more bullish picture for gold. And again, to start breaking it down, I can and I will, but I would just need to hear interest in going down, because I don't mind doing gold. I am a gold bug from way back, and I like to add it. So, but it's a lot of additional work. All right, so gold still giving me, positive thoughts about where it should go. I'm going to go back out to silver. Silver, on the other hand, is a little bit disappointing. Gotta say, a little bit disappointing. If I open this up just a little bit, I'm not really jumping up and down on this, but it's not bad. But I needed to kind of grab hold, don't go falling too far, and to start taking off, because it's really got to start to climb. If this is just all going to be just a small minor wave one, then yeah, maybe we get up to here, we start pulling back, but it's going to be at a position where it'll just go. We'll get one of these. All right, now let me get started on what long view also want. And that, of course, is the SPX. Starting here on our maximum chart, no changes. You can just see it now in log scale, right? This is 1929, bangity bangity boom, down to 1932. And then we get the gigantic rally in the SPX, as known as supercycle wave 3, coming all the way down. Supercycle wave 3. This is the pandemic low. Now, I'm going to go back over. Well, actually, yeah, I'm going to go back over for right now quickly into our candles so we can see the patterns. All right. We can see this is primary wave 4. That is still an area that I'm looking for. And I am just going to, we can go that way. I'm going to leave that up. And we're putting on where we think primary wave C can come. So we have a lot of this coming down. And so we're looking for the primary C wave to come down here and put in for cycle A. We're going to get a cycle B, and then we have a cycle wave C coming down, right? This is what we got going on. For 2023, I'm looking for the bottom of a primary C wave, followed by the completion point of cycle wave A, a nice cycle wave B rally to finish off 2023, pushing us out into 2024, get up to that top for that B wave and start a cycle C wave down, which likely will take, again, all of 2024 into 2025 before we're again down into areas that the market can grab hold of, start putting a lot of things behind it, seeing the light at the end of the tunnel type stuff. So in the meantime, I do see that the market's going to continue to go down. Now, if we go all the way down, I'll go down to on the SPX on the daily chart. Look at Friday. There's Friday. It was an extremely strong day. No doubt. It was an extremely strong day. It was incredible. But remember how I left it on Thursday? And on Thursday, I basically stated that the employment situation number, the employment data, would provide the catalyst to drive this market directionally. I said, if for any reason they could tie a bullish picture to that data, this market was going to go, because the short squeeze was then on. So I think this was all preset. That number, you can go and you can get estimates and consensus, and we're going to pull it out. We're just going to go for it. We will turn into a massive buyer, and that's exactly what they did. Now, that was the first half hour into trading, or the first hour and a half into trading. Then they did sell it. And they brought it down. They didn't move it to new lows, but the sellers, or I think retail, that were basically like, well, that was not a good number. That's an inflationary number. Less people are getting unemployed, more people are getting work. Oh, well, what does that mean? Well, it means the Fed's going to continue. We even had a Fed governor come out and basically start to talk about that, gee, don't get overexcited with this. We're not going to pivot. We are going to continue with our plan, and that's to continue to raise interest rates steadily over the next year. So again, it's like, okay, market, whatever you want to do. But I want to tell you again that within the equity markets, that expiration likely had nothing to do with being bullish or bearish. It had everything to do with the number, the strike, and the position that gets put on and wrapped around a strike, wrapped around a level in the SPX. Because these things, when they expire, folks, they expire into cash. It's a done deal. There's nothing at risk. No, I'm not going to buy it. I'm getting shares. You're buying dollars. You're going to settle in cash. And that's it. And that's how it works. And we move on. So big change on Friday. We saw this humongous rally, which I will comment again on tomorrow's Elliott Wave update. So right now, let's suffice it to say that I'm going to break this down again, and we're going to go down to the hourly chart just to quickly do it. I will go into detail tomorrow, but on the SPX, we were looking at this is the end of minor wave 1, and this is all a minor 2, but we needed it to come up and get itself above 38.91. Well, sure enough, it did. Now, we have to leave open the possibility, and it went up and it made a new high above there and above there. So it's doing perfectly in terms of, and we got an ABC, and then we got an X. This is a triple. If nothing, maybe than just a single. But it's an ABC, X, ABC, X, ABC. Off of that low, and trust me, it came almost all the way down. On Thursday, it came all the way down to the bottom before it would break it, and it didn't break it, and then rallied in 5. And we have to leave open the possibility that we will get up to the retracement levels that we've been using. And in the SPX, that's going to be 39.33. 39.33. It's 37, so it's going to be a little bit higher in the future, maybe not. But 39.33 in the cash, with potential that it could go to 39.70. So when I have heard, there's a couple of subscribers that are basically talking 39.50. So people's different fib levels and it all, but you see how it fits, because it's going to come in between 50 and 618. And can a minor 2 do that? Sure can. It really can. But that would suggest that on Monday we're going to rally, and we should rally strongly back above 3,900. We may get it. We'll wait and see. Moving averages are all basically falling in line, but we have everything except the 200, which basically still remains flat. And that broader 500 in the SPX, it remains pretty flat, but we have the 5, the 8, the 20, and the 50 all now pointing higher. Oops, wrong one. Let's go like that. Then you can see it. So it all's lined up, but the 200 is pretty flat. So I think we're very close. Maybe another quick little run, and then we're done. Over in the NDX, it's basically the same deal. Same deal. And here again, let me take this back out. Let's take a look at the weekly. Boom, boom, boom. 1, 2. You can see on the weekly basis, it looks like nothing, but we're screaming because, oh my God, look what we exploded higher. We were up 300 in the NDX. Oh my God, we're getting bullish again. It's like, nah, not really. We have components that they, accumulation distribution. Again, in the equity markets, that's what's happening. Happened at the end of the year. Well, now they got all that money. It's got to go somewhere. So we're still seeing it. We're still seeing it's like, well, I don't like Microsoft. I got some to sell. Boom, you sell it. But I'm a buyer, so I like it. We'll take it. Fund managers, ETF, asset managers, they're putting their money where they think it's going to happen. We get to trade it, and that's the beauty of it. So we don't have to take an opinion, and we don't have to go beyond months and months and months and promise a bunch of people, here's some results. If you're really trading for yourself, do so. You can play every single move. You don't have to look at the long picture. You look at the daily and you make your moves. So in any case, it is just still minor wave, intermediate wave 2 coming off. Minor wave 1, ABC. Still needs to get a little bit higher. in that NASI cash. So we still have upside that we can do in the NASDAQ. So the futures market got above it, but this one didn't. So we're still, yeah, like 11,121. Yeah, let's go up and give a test here. Not all that much left, to be honest. It's only 80 points from here. And then I think that we're done here as well. And then if we're done, that's a C. We're going to drop into the start of a minor third wave, and that should be pretty dynamic. And I'm just praying that it's going to also be extremely recognizable, and it should be, because it should be like this: down, up, down, up, down. No, not okay. Up, no, down, nope, down, 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 nope, up, no, down. All of this noise, that it's recognizable, not corrective. It is impulsive. That'll be the big difference here as well. In the NDX, 200 flat as a pancake, but there's where it's sitting, right there at resistance. We need to get above there. There sits the resistance level. Go for it, guys. Let's get it over with and start your next move. And that's where I am going to finish today. I thank you so much, and I gave that little bit of extra time that I normally would put into the equity markets. I put it into the bond markets, the treasuries, and on the yield side. Those are important. There's a lot of trading going on over there. So thank you for indulging me. Thank you for listening. And the next podcast will be next Saturday, but also coming, I am finally getting finished on the edits. There will be guests. I have 3 that are running. I'm running through the edit, and they should be coming out. Thank you again. Have a great evening.